the collapse was a lie. The G-SIB secret they don't want you to know in 2008, they told you the system broke, they told you it was fixed. Basel III, capital requirements, global systemically important banks. But what if the entire narrative was strategic misdirection? What if those 30 banks they designated weren't being restricted, but protected? What if the G-SIB framework didn't prevent the next collapse, but guaranteed it? There is a mechanism hidden in plain sight. And when you understand what it actually does, everything changes. Welcome to financial inspection. If you've spent decades building, protecting capital, making decisions that matter, then you understand the value of information others overlook. We don't ask you to smash buttons. We simply invite you, as one professional to another, to subscribe. Because the next 20 minutes will reframe how you see the entire global financial system. And before we begin, tell us in the comments, where are you watching from? New York, London, Singapore, Mumbai? Because what we're about to reveal affects every market, every jurisdiction, every decision you'll make in the next 5 years. Let's begin. In the autumn of 2008, the world watched as the impossible became reality. Lehman Brothers collapsed. AIG teetered on the edge. Merrill Lynch disappeared into Bank of America overnight. The financial system, which economists had declared stable just months earlier, revealed itself to be built on foundations of sand. Trillions in market value evaporated. Retirement accounts vanished. Businesses couldn't access credit. The machinery of global commerce seized. But then came the response. Governments intervened. Central banks printed money. Regulators promised reform. And over the next several years, a new framework emerged. They called it Basel III. It was sold to the public as the solution, the safeguard, the thing that would ensure this catastrophe could never happen again. At the heart of this new system was a designation, a list. 30 banks, carefully selected, would be labeled as Global Systemically Important Banks, G-SIBs. These institutions, the regulators explained, were different. They were so large, so interconnected, so critical to the functioning of the global economy that their failure would trigger systemic collapse. Therefore, they would face stricter rules, higher capital requirements, more oversight, more restrictions. The public was told this made sense. If these banks were too big to fail, then they needed to be constrained, regulated, controlled. The narrative was simple and reassuring. The crisis happened because banks took excessive risks. Now, the biggest banks would be forced to hold more capital as a buffer. They would be monitored more closely. The system would be safer. For most people, this explanation was sufficient. The technical details didn't matter. What mattered was the promise. What mattered was that someone, somewhere, had learned the lesson. The regulatory alphabet soup of CET1 ratios, risk-weighted assets, and systemic importance scores remained the domain of specialists. The general public moved on. But there was something the regulators didn't emphasize, something buried in the mechanics of how this system actually worked. The G-SIB designation wasn't just a regulatory burden. It was also a signal, a message to the market. And markets, as always, interpreted that message in their own way. When a bank received G-SIB designation, something curious happened. Yes, they faced higher capital requirements. Yes, they had more regulatory scrutiny. But they also gained something invaluable. They gained implicit confirmation that they were, in fact, too big to fail. The designation itself became a guarantee. Not a legal guarantee, of course, but a practical one, a political one. Investors understood this immediately. If the government had officially declared these 30 banks systemically important, then the government had also declared, however quietly, that it would not allow them to collapse. The moral hazard that caused 2008 hadn't been eliminated. It had been codified, institutionalized, given a formal framework. This created a strange incentive structure. G-SIB banks could borrow money more cheaply than their competitors. Why? Because lenders knew these institutions had an implicit backstop. The funding cost advantage wasn't dramatic, but it was real. A few basis points here, a few there. Over billions in assets, these small advantages compounded into enormous competitive benefits. Smaller banks watched this happen. They saw capital flowing toward the designated institutions. They saw depositors and creditors preferring G-SIBs because of perceived safety. The regulatory framework designed to constrain the largest banks was actually strengthening their market position. The system was concentrating, not diversifying. Meanwhile, the public continued to believe the official story. The crisis was over. The reforms had worked. The banks were safer. The capital ratios proved it. The stress tests confirmed it. Everything was fine. But beneath the surface, something else was happening. The G-SIB framework wasn't just about bank safety. It wasn't even primarily about bank safety. It was serving a different function entirely, a function that had nothing to do with preventing collapse and everything to do with managing it, with controlling it, with ensuring that when the next crisis came, the architecture was already in place to handle it in a very specific way. The designation system had created a network, a structure, a mechanism of control that most market participants didn't fully understand. And that mechanism, hidden behind the technical language of regulatory reform, was about to become the most important feature of the global financial system. Because the real secret wasn't that these banks were too big to fail. The real secret was why they couldn't be allowed to fail. And that reason had nothing to do with their size. The banking system operates on layers most people never see. On the surface, there are deposits and loans, checking accounts and mortgages, credit cards and savings. This is the banking the public understands. But beneath this visible layer exists something far more complex. A network of transactions that dwarf retail banking by orders of magnitude. This is where the G-SIB story really begins. When regulators created the systemically important bank designation, they published a methodology. 5 categories would determine which banks made the list. Size was the obvious one. Total assets, balance sheet footprint. But the other 4 categories revealed something more interesting. Interconnectedness measured how entangled a bank was with other financial institutions. Substitutability assessed whether other banks could replace its functions if it disappeared. Complexity evaluated how difficult the bank would be to resolve in bankruptcy. Cross-jurisdictional activity tracked its global operational spread. These weren't random metrics. Each one pointed to a specific type of risk, but they also pointed to a specific type of power. A bank that scored high across all 5 categories wasn't just large. It was embedded, irreplaceable, operating across borders in ways that made it nearly impossible to untangle. The scoring system wasn't identifying banks that needed restriction. It was identifying banks that had achieved escape velocity from normal market discipline. Within months of the first G-SIB list being published, something unexpected happened in the credit markets. The spread between G-SIB bonds and non-G-SIB bonds began to widen. Not dramatically at first, just a few basis points. But the direction was clear. Investors were pricing in a guarantee that didn't officially exist. They were betting that governments would never allow these designated institutions to default. And they were right to bet that way. This created a feedback loop. G-SIBs could borrow more cheaply. Cheaper funding meant they could offer better terms to clients. Better terms attracted more business. More business increased their systemic importance scores. Higher scores reinforced the implicit guarantee. The cycle continued. The framework designed to limit these banks was actually subsidizing their expansion. Executives at regional banks watched this unfold with growing concern. They faced the same regulations, the same capital requirements for their size class, but without the funding advantage. They couldn't compete on price. They couldn't match the global reach. The designation had created a moat around the largest players that no amount of efficient management could overcome. The market was sorting itself into 2 tiers, the protected class and everyone else. But there was something even more significant happening beneath this competitive dynamic. The G-SIB banks weren't just commercial institutions anymore. They had become infrastructure, critical nodes in a global system that moved dollars, euros, yen, and pounds across borders every second of every day. They operated in the repo markets, providing overnight funding to governments and corporations. They managed the derivatives books that allowed companies to hedge currency and interest rate risk. They processed the correspondent banking relationships that enabled smaller banks to access international markets. This infrastructure role was never part of the public narrative. The crisis story focused on mortgages and investment banks, on greed and speculation. But the real systemic importance of these institutions had nothing to do with residential lending. It had everything to do with their position as intermediaries in the wholesale funding markets, as dealers in the multi-trillion-dollar repo system, as counterparties in derivative contracts that spanned the globe. The Federal Reserve understood this perfectly. So did the Bank of England, the European Central Bank, the Bank of Japan. When they designated these banks as systemically important, they weren't worried about retail deposit runs. They were worried about the overnight funding market seizing, about the repo system freezing, about the derivatives network fragmenting. The G-SIB framework wasn't protecting depositors, it was protecting the plumbing. And here was where the regulatory illusion became most apparent. The capital buffers. These banks were required to hold, looked substantial on paper. an extra 2% here, 3% there. But these buffers were measured against risk-weighted assets, not total exposure. A government bond received a 0 risk weight, and AA-rated security received minimal weight. The actual leverage these institutions carried was far higher than the official ratio suggested. More importantly, the capital requirements assumed the banks would have time to raise money in a crisis, that markets would remain open, that counterparties would continue trading, that the repo market would keep functioning. But in every real crisis, these assumptions evaporated instantly. Liquidity disappeared, markets froze. And when that happened, capital ratios became irrelevant. What mattered was access to emergency funding. What mattered was whether the central bank would step in. The G-SIB designation guaranteed that access, not through any written rule, but through the logic of the system itself. If these banks were officially too important to fail, then they would receive whatever support necessary to prevent failure. The framework had transformed moral hazard from an unfortunate side effect into a deliberate feature. The largest banks now operated with an explicit understanding that catastrophic mistakes would be socialized, while profits remained private. This wasn't a flaw in the system. It was the system, and very few people understood just how deep the implications ran. September 2019, a date most people don't remember. No bank collapsed, no market crashed. The headlines barely registered the event. But in the overnight lending markets, something extraordinary happened. The repo rate, which normally hovered near the Federal Reserve's target, suddenly spiked to 10%. Then higher. Institutions that needed cash couldn't get it. Institutions with cash wouldn't lend it. The machinery that funds the financial system every single night simply stopped working. The Federal Reserve responded within hours. Billions poured into the market, then tens of billions, then hundreds of billions. Emergency facilities appeared overnight. Standing repo operations became permanent fixtures. And just like that, the crisis vanished from public view. Markets stabilized, rates normalized. Business journalists moved on to other stories. But something profound had been revealed in those 48 hours. Something about what the G-SIB system actually protects. The repo market is invisible to most people. It doesn't appear on the evening news. Politicians rarely mention it. But it is the foundation upon which the entire modern financial system rests. Every night, institutions that need short-term cash pledge securities as collateral and borrow from institutions with excess funds. The loans last one day, sometimes just overnight. The next day, the process repeats. Trillions of dollars move through the system daily. It funds everything from government operations to corporate payrolls to investment portfolios. And sitting at the center of this market are the G-SIB banks. They operate as dealers, as intermediaries, as market makers. When a pension fund needs overnight cash, it goes through a G-SIB. When a corporation wants to invest excess dollars for 24 hours, it goes through a G-SIB. When a foreign central bank needs to manage its dollar reserves, it goes through a G-SIB. These institutions don't just participate in the repo market. They are the repo market. This creates a dependency that goes far beyond traditional banking. If a regional bank fails, depositors might lose access to funds temporarily. If the FDIC steps in, accounts get transferred. Life continues. But if a G-SIB fails, the overnight funding market collapses. Corporations can't make payroll. Governments can't roll over debt. Pension funds can't meet redemptions. The entire dollar-based financial system experiences cardiac arrest. This is why September 2019 mattered. The spike wasn't caused by a bank failure. It was caused by a temporary imbalance between supply and demand in the repo market. A technical issue. A plumbing problem. And yet, it required immediate, massive central bank intervention to resolve. The incident revealed that the system wasn't just dependent on these banks continuing to exist, it was dependent on them continuing to function perfectly every single day without interruption. But the repo market is only one piece of the infrastructure these institutions provide. The offshore dollar system is even larger and even more critical. Dollars don't just circulate in the United States, they circulate globally. Companies in Asia borrow in dollars. European banks fund in dollars. Governments hold reserves in dollars. And all of these dollars, all of this offshore dollar liquidity, flows through a network of banks that can create dollar liabilities outside the direct reach of the Federal Reserve. The G-SIBs are the primary nodes in this network. They operate across jurisdictions. They maintain correspondent relationships with thousands of smaller banks worldwide. They provide foreign exchange services. They manage cross-border payment systems. When a company in Brazil needs to pay a supplier in South Korea in dollars, that transaction routes through G-SIB infrastructure. When a central bank in Southeast Asia wants to stabilize its currency, it accesses dollar swap lines that connect through G-SIB balance sheets. This offshore dollar system is larger than the domestic dollar system. The numbers are staggering. Tens of trillions in dollar-denominated obligations exist outside the United States, and none of it is backed by FDIC insurance. None of it has direct access to Federal Reserve lending facilities. It exists in a shadow space. dependent entirely on the willingness and ability of G-SIB banks to intermediate. During March 2020, when the pandemic triggered market chaos, the system came within hours of complete breakdown. Foreign banks couldn't roll over dollar funding. Corporate borrowers couldn't access dollar credit lines. Even sovereign nations struggled to obtain the dollars they needed for critical imports. The Federal Reserve responded by opening unlimited dollar swap lines with foreign central banks. Unlimited. The word itself reveals the stakes. There was no ceiling on how many dollars would be provided, because the alternative, the collapse of the offshore dollar system, was unthinkable. And who distributed those dollars? Who acted as the transmission mechanism between the Federal Reserve's swap lines and the global economy? The G-SIB banks, they weren't just commercial entities being rescued, they were infrastructure being preserved. They were the pipes through which monetary policy flows to the world. This is the function that G-SIB designation actually protects. Not shareholder value, not executive bonuses, not even depositor funds in the traditional sense. The designation protects the operational continuity of the global dollar system. It ensures that the mechanism for distributing dollars worldwide remains intact, regardless of the financial condition of any individual institution. The political economy of this arrangement benefits everyone in power. Governments need these banks to maintain dollar hegemony, to enforce sanctions, to manage international trade, to project monetary influence across borders. The banks need government protection to operate with leverage that would be suicidal without an implicit backstop. It's a symbiotic relationship disguised as regulation. What the public was told after 2008 was that big banks would be constrained. What actually happened was that big banks became formal extensions of sovereign monetary policy. The Basel III framework didn't restrict them, it conscripted them. The capital requirements were never meant to prevent failure. They were meant to maintain just enough solvency to keep the infrastructure operational during stress. This is why the G-SIB designation can't be understood through traditional banking analysis. These aren't companies that happen to be important. They're utilities that happen to be private. And the next crisis won't be about whether they survive. It will be about whether the system they enable can survive their vulnerabilities. The markers are already visible, not in the places people are looking, but in the structural shifts happening beneath market calm. Interest rates, after more than a decade near zero, have moved into territory that changes everything. When money was free, balance sheet problems could be rolled forward indefinitely. When borrowing costs rise, those same problems become acute. And across the G-SIB network, balance sheets are carrying weight they were never designed to bear at these rates. Unrealized losses sit in the hundreds of billions. Government bonds purchased when yields were 1% are now worth significantly less in a 4% environment. Accounting rules allow banks to classify these as hold to maturity, avoiding mark-to-market recognition. On paper, the losses don't exist. In reality, they represent capital that has evaporated. If these institutions needed to liquidate quickly, if they faced a funding crisis that required selling securities, the losses would materialize instantly. The capital buffers regulators point to would prove inadequate within hours. But this is a known vulnerability. Regulators are aware. Markets are aware. The real danger lies in places the 2008 framework never anticipated. Commercial real estate has become a slow-moving catastrophe. Office buildings sit empty. Valuations have collapsed. Loans made when occupancy was 90% now back properties at 50% capacity. Regional banks hold concentrated exposure to this sector, and as those loans default, stress transmits upward through the system. GSIBs don't hold the mortgages directly, but they hold the derivatives, the credit default swaps, the structured products built on top of those mortgages. When regional banks fail, G-SIBs face counterparty exposure. Then there are the derivatives themselves. The notional value of outstanding interest rate swaps alone exceeds $500 trillion. Notional isn't the same as exposure, but when rates move violently, when correlations break down, notional becomes relevant very quickly. These contracts link every major institution to every other major institution in chains of obligation that are impossible to fully map. A default by one counterparty cascades through this network in ways that stress tests cannot model because the models assume orderly markets and rational behavior. Neither assumption holds during actual crises. The G-SIB framework was designed for a world where financial stress originated in American subprime mortgages and European sovereign debt. It wasn't designed for a world fragmenting along geopolitical lines. China's financial system operates increasingly separate from Western infrastructure. BRICS nations are building alternative payment rails. Dollar dominance isn't collapsing, but it's facing challenges that didn't exist when Basel III was written. And those challenges create new failure modes for institutions whose systemic importance derives from their role in dollar intermediation. Digital assets have introduced another variable. Stablecoins now represent hundreds of billions in value, and their reserves are held where? In short-term government securities and bank deposits, at G-SIB institutions. If confidence in stablecoins breaks, if redemptions accelerate, Billions in deposits could flee the banking system in minutes, not days, minutes. The speed of digital panic is fundamentally different from historical bank runs, and the plumbing isn't designed to handle that velocity of withdrawal. Meanwhile, the very feature that made G-SIB systemically important, their interconnectedness, has become more concentrated rather than less. Mergers have continued. The largest institutions have grown larger. The network has fewer nodes, but higher dependency on each node. When one struggles, the contagion pathways are shorter and faster than they were in 2008. The system is more efficient in stable times and more fragile in unstable ones. For the business community, this creates a planning problem that can't be ignored. Treasury management strategies built on assumptions of banking system stability need reassessment. Counterparty risk isn't just about credit ratings anymore. It's about understanding exposure to institutions whose failure would trigger government intervention of uncertain scope and timeline. Will deposits be protected? Will credit lines remain accessible? Will payment systems continue operating? These aren't hypothetical questions. They're strategic contingencies that require concrete preparation. Diversification becomes essential. Spreading deposits across institutions and jurisdictions. Maintaining relationships with multiple banks, not for rate advantages, but for redundancy. Understanding which assets can be liquidated quickly without depending on G-SIB infrastructure. Building treasury buffers larger than traditional models suggest because access to credit markets cannot be assumed during stress. Supply chain finance deserves particular scrutiny. Many corporations rely on short-term credit facilities to manage working capital. Those facilities are provided by G-SIBs and depend on the overnight funding markets continuing to function. If repo markets freeze again, if wholesale funding becomes unavailable, these credit lines could be suspended precisely when they're needed most. Alternative financing sources, whether through direct lender relationships or different capital structures, become critical backup plans. Capital allocation decisions must account for a scenario most strategic planning ignores. What happens if the dollar system experiences serious disruption? Not collapse, but disruption. A period where cross-border payments slow, where currency markets become illiquid, where the infrastructure, taken for granted, becomes unreliable. Holding some assets outside the traditional banking system, whether in physical form or through alternative custody arrangements, becomes prudent risk management rather than paranoid preparation. The indicators to monitor are specific. Watch the repo markets. When overnight rates spike above the Fed's target without obvious cause, the plumbing is straining. Watch the Federal Reserve's balance sheet. When it expands rapidly outside of announced policy, emergency support is being provided quietly. Watch the credit default swap spreads on G-SIB debt. When they widen significantly, markets are pricing in stress that official statements deny. Watch cross-border dollar funding costs. When foreign institutions pay premiums for dollar access, the offshore system is experiencing strain. None of this suggests immediate crisis. Markets can remain stable for extended periods, even with underlying vulnerabilities. But stability in complex systems is often an illusion, sustained by continuous small interventions that prevent recognition of fundamental problems. The G-SIB framework is such an intervention. It doesn't solve systemic fragility. It manages it through guaranteed support that delays but amplifies eventual consequences. The collapse in 2008 was real. Banks failed. Markets froze. The crisis was genuine. But the solution wasn't genuine. The solution was a framework that formalized the problem, gave it official designation, and built an architecture to ensure the next crisis would be managed rather than prevented. G-SIB status doesn't make banks safer. It makes their failure more carefully orchestrated. And that orchestration depends on maintaining public confidence in a system whose actual stability is far more conditional than anyone wants to admit. The business community cannot afford to operate on the assumption that this framework will hold indefinitely. It was built for the last crisis, not the next one. And the next one, whenever it comes, will exploit vulnerabilities that current regulations don't address because they cannot even recognize them. Strategic positioning means understanding that the financial infrastructure treated as permanent is actually provisional, dependent on continuous intervention, fragile in ways that only become obvious when the interventions stop working. That understanding changes everything about how serious decision makers should think about capital, liquidity, and risk in the years ahead.